American capitalism has changed significantly since the 2008 financial crisis. The state's response to the crisis, which was marked by emergency actions from the Federal Reserve Bank and the Treasury, not only saved the financial system, but completely changed the contours of corporate power in the United States. If for centuries the banker barons dominated the country's economic landscape, the new system had new masters. Now, the economic recovery plan initiated with Obama would open the way for a new arrangement, which would no longer be in the hands of the banks. But in the giants of asset management, BlackRock, Vanguard, and State Street, these companies became the true nerve centers of the American economy by accumulating an unprecedented scale of corporate ownership. Unlike the classic model, where company control was separated, with managers on one side and shareholders on the other, the rise of the Big Three broke down that separation. As passive investors, these asset managers couldn't freely sell shares to put pressure on companies. So, they chose direct means of control, influencing the strategic and operational decisions of the industrial corporations in their portfolios. The American economic decline, which would lead to the 2008 crisis, would cause the American system to be taken over by titans who would use the American economy as a weapon in partnership with the American government itself. We'll cover the details of this union in today's video. Before that, remember to subscribe and share the video with everyone you know. To help the World Geopolitics channel continue to exist, your support is very important. My name is Guilherme Peta, and this is the World Geopolitics channel. In general, bankers just finance companies, earning more from the success of these companies, but also earning, although less, from the failure of these companies. Basically, the global game is a system where bankers rarely lose, but in 2008, many did, and that led to the emergence of a new system, where now investors would not only finance the companies, but would also start running them in search of continuous capital appreciation through stocks, dividends, interest, and mainly political and social manipulation to ensure control over supply and demand. As usual, the most foolish will say this is a problem with capitalism, but that's it, the most foolish, because there's nothing capitalist about this. On the contrary, it's the appropriation of the capitalist system by agents who don't want capitalism, don't want competition, and above all, don't want a free market system. This has always existed to a degree, but only to some extent, as I said. Because in the current model, which was born around 2008 with the crisis in the United States, this caused that fusion to happen in an even more concentrated and systemic way. Financialization, understood as the dominance of monetary capital logics over production and social life, has taken on a new form, with these giant asset managers, which have become universal owners, exercising continuous control over almost all publicly traded companies in the United States, a good part of the world, and even over governments. BlackRock, for example, directly controls about $10 trillion in assets and, indirectly, almost $25 trillion through its platform. Aladdin being among the largest shareholders of 98% of the companies listed on the S&P 500. American financial development has four phases: classical financial capital, 1880-1929, managerialism, 1930-1979, neoliberalism, 1980-2008, and new financial capital, 2008-present. In the classical phase, investment banks like John Pierpont Morgan created industrial conglomerates and controlled companies through large blocks of shares and the provision of credit, taking seats on boards and creating networks of interconnected directorships. This concentration was dissolved after 1929 with the arrival of the managerial phase, in which the separation between banks and industrial companies was imposed by regulation, and internal corporate managers came to dominate without large shareholder blocks to challenge them. In the managerial phase or managerialism phase, corporate power was supported by a donor state. New Deal, which tried to sustain the economy through labor rights, social security, redistributive taxation, and an alliance with labor unions. It also expanded business organization based on highly diversified and globalized multi-divisional conglomerates, mainly in tune with the American military-industrial complex. However, during the crisis of the 1970s, this model entered into contradiction. The power of the labor unions began to threaten the economy itself, which forced a new restructuring now called neoliberal. In the neoliberal period, financial power strongly resumed the global integration of markets. The rise of professionally managed pension funds and the decentralization of business operations created a new form of financial hegemony. Unlike the classical era, this power was spread across multiple financial institutions that competed with each other, disciplining companies in a structural way. It was within this hegemony that industrial companies began to internalize financial functions, and treasurers became CFOs or financial directors, business or financial directors. With conglomerates adopting flexible subsidiaries and management starting to be guided by financial metrics, anticipating the full financialization model, companies expanded into the derivatives market to protect against globalization risks. After all, now the United States would no longer be the only engines of the world economy, and other competitors, especially in Asia, would start to emerge. But in 2008, a new historical moment emerged. The financial collapse resulted in 4 megabanks consolidating: John Pierpont Morgan Chase, Bank of America, Wells Fargo, and Citigroup. And here's the crucial point: the real post-crisis power became concentrated in the asset management firms. That's because the American government, by reducing systemic risk through regulation and guaranteeing liquidity, made it easier to channel savings into stocks. And these stocks were, for the most part, managed passively by the big three. Pension funds and other institutional investors began to delegate the management of trillions of dollars to these companies, further expanding their ability to centralize ownership and corporate control. The name of the model is passive management, but there's nothing apathetic about it, because since they can sell shares strategically, the asset managers directly influence them, shaping governance practices, sustainability, executive compensation, and organizational structure of the companies that make up the indices they replicate. Thus, a small number of entities came to control, directly or indirectly, the core of global productive capital. The magnitude of this transformation is visible in the political influence that these companies have acquired, especially the famous BlackRock. In addition to its structural penetration in the markets, it maintains close ties with the American state, with its former executives holding prominent positions in Democratic and Republican governments, and even now, in the Trump administration of 2025. This alliance with BlackRock was crucial for an indebted and morally weakened American government, because it would allow Washington to extend its foreign policy even further to an unprecedented level. Meanwhile, for BlackRock, this alliance would be fundamental by guaranteeing political legitimacy, by pressuring other countries, and by using military force against those who try to challenge them. Today, the correlation between the State Department and these investment funds is already a single organism pursuing the geopolitical interests of the United States. As always, the Marxists were wrong to think that the state would be the answer to these major controllers of capital, because in real life the state always uses them as tools and discards them when convenient. What we see is an advanced stage of financialization, where this capital has ceased to be just an instrument of financing or a form of ownership, becoming the very mechanism of control over social and economic reproduction. This new formation of financial capital represents a synthesis of the historical process that began back in the 19th century, but now elevated to a totalizing scale, where the state, the market, and corporations are merging under the hegemony of a concentrated impersonal capital, managed by algorithms and shielded against any effective form of democratic control, generally both in leftist discourse and in public policy platforms. Since 2008, the rise of finance has been portrayed as parasitism, which corrodes the real and industrial economy, being blamed for social inequality, recurring economic crises, and the decline of well-paid work. But no, because in reality, financialization is a distortion of the productive economic order and an indication of the collapse of American hegemony. Many critics argue that this finance has imposed a destructive short-termism that led companies to neglect investments in skilled jobs and innovation, prioritizing immediate rewards to shareholders such as dividends and stock buybacks. But it's not that simple, because we're seeing their bet on the long term in companies that aren't so profitable. Investors supported giants like Uber, Tesla, and Amazon for years, even with ongoing losses, because they saw business models that could be profitable in the future and could break smaller competitors. Thanks to state support, this shows that financial logic isn't necessarily tied to the short term, but rather connected to strategic perceptions that go beyond just financial profit. The belief that paying dividends and buybacks necessarily harms investments in research and production also doesn't hold up. In a low-interest environment, corporations were able to invest heavily in research and development while also rewarding their shareholders. Data shows that over the past 4 decades, corporate investments and spending on innovation have grown as a proportion of the American gross domestic product, along with profits and dividend payments. This disproves the thesis of financialization as an unproductive drain on resources. Many Marxists link the declining industrial profit rate since the 1960s to financialization. They argue that, faced with low industrial profitability, capital migrated to the financial sector, thus creating speculative bubbles to mask real stagnation. But this interpretation suggests that the current focus on finance would be a reflection of the crisis of capitalism, marked by overproduction and overaccumulation. But this perspective relies on a very reductionist interpretation of the notion of fictitious capital that Karl Marx discusses, treating a large part of financial capital as something disconnected from productive reality. This binary view between real and fictitious capital is misleading. Financial capital, even in seemingly abstract forms, remains linked to the extraction of real value, whether through the control of corporations, the organization of global production, or the coordination of capital flows. What is at stake is not the decline of an exhausted system, but the continuous reconfiguration of its internal logic. Marxists have been pointing out the inevitable fall of capitalism for more than a century, but all we've seen is the fall of socialist regimes. Financial capitalism does not represent a final break with the past, but a metamorphosis adapting to the new context of the 21st century. What Marxist analysts ignore is the active role of the American state in building the global financial order, which, far from being an actor captured by the financial sector, it was the state that played a central role with relative autonomy, mediating the interests of different economic factions and fractions. Financialization is not antagonistic to the American empire. It is the new pillar that sustains the global hegemony of the United States, or at least tries to. Since the post-war period, the American state has achieved financial liberalization and unrestricted capital mobility for a specific purpose. This required the development of very specific state capabilities, such as the centralization of power in the Federal Reserve Bank and the United States Treasury. Shielded from democratic pressures and able to act flexibly in managing the contradictions of the global system. Just as Rome ceased to be a monarchy and later became a republic, its collapse did not lead to the end of the Roman geopolitical entity, but rather to the emergence of the Roman Empire. We have evidence to point this out in the case of the United States as well, not its collapse as many imagined, but its transformation. Because throughout the 20th century, the expansion of the state's economic functions resulted in the formation of an authoritarian structure. Within democracy, increasingly less connected to the idea of traditional capitalism, that naive, childish, innocent, adolescent perception of the United States as the great bastion of liberal democracy and free market capitalism has been over since 2008, and this will become more and more evident. It has already happened, but it is taking time to become tangible, and we will all see this in the coming years. This new adaptation would be structured symbiotically with asset management giants like BlackRock, Vanguard, and State Street, with the state actively supporting the appreciation of monetary capital through the continuous inflation of asset prices. This relationship between the state and investment funds created a system in which the risks of corporate capital were progressively absorbed by the public sector, attracting even more savings to the stock market, and consolidating the dominance of these asset managers as universal owners of the economy. They influence most major companies and wield political power, with executives serving in the Trump and Biden administrations and coordinating with the Federal Reserve Bank. Ironically, in the beginning, many people, especially on the left, supported this new policy, because along with it came social and environmental commitments, and for supposedly wanting a system that would aim for economic stability. Joe Biden's moderate attempts to expand social programs have failed, and the green investments promoted by this financial capital have promoted themselves. They're just tools of American external political pressure and of its European allies. The idea that the universalism of investments could also promote long-term policies aimed at the common good was also another pretty stupid thing. Given the reality of environmental, social, and governance and diversity, equity, and inclusion, since these strategies mainly assess the financial risk that environmental and social issues pose to company profits rather than driving ecological progress. The goal was never to reduce carbon emissions or restore endangered ecosystems, but to protect profits. And above all, to dictate the behavioral policies of companies and governments through their stock exchanges. As BlackRock's own chief executive officer said, they wanted to force behaviors. This goes far beyond money, with people who think money is power not understanding the rules of the game that are being set. Money was never power, but power easily generates money. The situation wasn't worse only because, like today, the United States isn't the only economic engine. The public reacted very badly to environmental, social, and governance and diversity, equity, and inclusion policies, and on top of that, these policies led several companies to near bankruptcy. Soon, environmental, social, and governance initiatives were reassessed, with BlackRock announcing that it would support fewer environmental and social responsibility resolutions, considering them overly prescriptive. In other words, environmental, social, and governance and diversity, equity, and inclusion policies were effective in causing worldwide turmoil, eroding almost entire nations, but not all of them. Precisely because of global alternatives, such as China and India, among other emerging markets and alternative centers of global capital. But, fortunately, the fierce competition among these asset managers and the companies they invest in made any effective coordination toward the cooperative model unfeasible. What was the world's good luck? Even if a company adopted costly sustainable practices, competitors using cheap predatory methods would quickly outperform it. Reality ensures that capital will flow to the companies with the highest profitability, not to those with supposedly better social or environmental practices. In other words, it's no use for the company to just please that group of clean and tidy people. It's not enough. The COVID-19 pandemic, with its abrupt halt and restart of the global economy, revealed even more the fragility of this arrangement. To support the financial system, the Fed, the Federal Reserve Bank, expanded its powers like never before, going from lender of last resort to a direct agent in the corporate debt markets. Buying, for example, even junk bonds with direct assistance from BlackRock and without approval from the United States Congress. This process led to the nationalization of market-based finance. And in the end, in the 80s and 90s, when everyone was worried about the rise of big corporations above the state, which turned out to be a pretty dumb thesis, the truth is more complicated. Because in reality, what we're seeing is the American state using these asset managers as tools of foreign policy, influencing and trying to determine the future of entire nations. Thank you all, I hope you enjoyed it, and don't forget to subscribe to the channel and share the video with everyone you know to help the World Geopolitics channel keep going. It may not seem like it, but your support is very important. See you in the next video.